You've probably heard about the XRP ledger, right? Maybe
Mhm.
seen XRP mentioned online or something.
Oh, yeah, it's definitely one of those names that floats around.
Exactly. But like, how much do people really understand what's going on under the hood? So think of this as your chance to get a proper look, your key to unlocking it.
Yeah, good way to put it. Today we're diving deep into the XRP ledger, and we've got a couple of sources to guide us.
Okay, what are we working with?
So first, there's the intro to the XRP ledger video. That's the XRP Ledger Foundation itself. Really lays out the basics, what it is, how it works, foundational stuff.
Right, the nuts and bolts.
Exactly. And second, we're pulling from a discussion called Shaping the Future of the XRP Ledger. This one features David Schwartz. He's one of the co-creators, a real OG, and Brad Garlinghouse, who's the CEO of Ripple.
Ah, so we get the inside scoop from the top guys.
That's the idea. Their chat gives us some great perspective on, the original thinking and where things are headed now.
Perfect. So our mission today, yours and mine, is basically to cut through the noise, pull out the really crucial bits about the XRPL for you listening.
Yep. Where it came from, how it actually functions,
Yeah.
and what its future might look like.
And we'll try to keep it clear, avoiding the super dense technical jargon where we can. Okay, let's get into it. Where did this whole XRP ledger idea even start? What was the spark?
Well, it's actually pretty interesting. The work started way back 2011, and it was three developers who were already working with Bitcoin.
Okay, so they knew Bitcoin, but they weren't satisfied.
Kind of, yeah. They saw Bitcoin's potential, obviously, but they also saw limitations. They wanted to build something, better in specific ways, more efficient, something that could scale up, and more sustainable long term.
More efficient, scalable, sustainable. Those are pretty big goals. What advantages did they bake in right from the start?
Well, they focused on some key things immediately. Speed, for one. Transaction confirmation times are really fast, like 3 to 5 seconds.
3 to 5 seconds. Compared to Bitcoin back then, that's light speed.
It really is. Think about payments, especially across borders. Going from days to seconds, I mean, that's a game changer.
Really? What?
Like fees, the transaction costs are typically tiny, usually less than a penny,
Wow.
which makes it practical for all sorts of transfers, big or small. And they also built in this fairness mechanism. Basically, no single entity gets to jump the queue and prioritize their own transactions. It's more of a level playing field.
Okay, fast, cheap, fair. Sounds like a solid base. But wasn't there more to it? Something about connecting different kinds of value.
Yes, exactly. That was a really core idea early on. The founders realized Bitcoin alone wouldn't solve interoperability. The problem of how different systems, different types of value talk to each other.
Like bridging the gaps.
Precisely. They needed bridges. So right
Huh?
from the start, they included the concept of issued assets. Think of them as precursors to what we now call stablecoins. And they built the ledger to handle multiple types of assets, not just one.
Hold on. Issued assets, multi-asset support. Back in 2011, 2012. That's really early for that kind of thinking.
It absolutely was.
Yeah.
Seriously ahead of its time. And it gets better. They actually built a decentralized exchange, a DEX, right into the ledger itself. That was 2012.
A built-in DE in 2012.
Yep. And the basic ideas behind stablecoins, they were there in the first releases, long before those terms were common in crypto speak.
That is genuinely surprising. Any other radical ideas from back then?
Well, another thing that was pretty different at the time was the idea of manageable accounts.
Manageable accounts. How's that different from, say, Bitcoin addresses?
With Bitcoin, you mostly deal with addresses, right? The XRPL introduced an account as a distinct thing you could manage, control permissions for, that sort of thing. It seems normal now because, interestingly, Ethereum actually adopted that same account model later on. But back then, compared to Bitcoin, it was a different approach.
Okay, so the why is clear efficiency, interoperability, foresight. Let's switch to the how. How does the XRP ledger actually function? What's the core tech?
Right, so fundamentally, like the Foundation's intro video explains, it's a decentralized blockchain. Open source, permissionless.
And a blockchain is basically a growing list of records, right? Blocks linked together?
Yeah, that's the essence. A chain of blocks, chronologically ordered, cryptographically secured.
So who maintains it? Who agrees on the new transactions?
That's the job of the validator nodes. These are trusted servers on the network. They work together to reach consensus on the next block of transactions.
How does that consensus process work? Is it like mining?
No, not like Bitcoin mining. It's different. Basically, transactions get proposed to the network. Validators gather these proposed transactions into lists.
Okay.
Then they share these lists with each other, incorporate changes they see on other lists, and propose a new potential ledger instance or block.
So they're all comparing notes, essentially.
Exactly. And when a supermajority, specifically 80% or more of these trusted validators agree on the exact same set of transactions.
80% agreement.
Right. Then that new ledger instance, that block, gets confirmed and added to the chain. And this whole cycle, proposal to consensus, usually takes just 4 to 6 seconds.
Wow, 4 to 6 seconds for finality. That's efficient. And once it's on the chain, it's locked in?
Pretty much, yeah. That's the immutability aspect of blockchain. Yeah. Each block has a unique cryptographic hash, like a digital fingerprint.
Right.
And it also contains the hash of the block before it, linking them together. Changing anything in an old block would change its hash, which would break the link to the next block, and so on. It makes the whole history tamper evident. You can always verify everything by going back through the chain.
Gotcha. Very secure. Now, one last technical bit I've heard about different networks. Mainnet, testnet.
Yeah.
Yeah.
Because the XRPL software is open source, anyone can run it. The main network, where the real XRP lives and real transactions happen, that's called mainnet.
Okay.
But for developers or anyone who wants to experiment, there are other networks, testnet and devnet. On those, you can get free, like fake XRP.
So you can build things or try features without any real financial risk.
Exactly. It lets people learn and innovate safely.
Okay, fundamentals make sense. Now let's pivot a bit. We know how it was supposed to work, the vision. How has the actual adoption played out? Because I hear there were some surprises.
Yeah, that's where the discussion with Schwartz and Garlinghouse gets really interesting. There was definitely a difference between maybe the early hopes and how things actually unfolded in the real world.
How so? What were the initial expectations?
Well, David Schwartz kind of hinted that maybe they initially thought there'd be more, grassroots adoption by regular people, maybe using it directly for cheaper international money transfers, things like that.
Makes sense. But that wasn't the first wave of real uptake.
Apparently not, or at least not as strongly as expected early on. What happened instead was that the traditional financial system seemed, well, more interested, more receptive, earlier than maybe anticipated.
Huh. So the banks and institutions jumped in.
In a way, yeah. Brad Garlinghouse had this great analogy. He talked about how tech disrupted retail, disrupted music.
Right, the whole software is eating the world idea.
Exactly. And he said, top is coming for finance. And what we're seeing now, according to them, is this trend of institutional DeFi.
Institutional DeFi. Okay, break that down. What does that mean for the XRPL?
So less about individuals directly using crypto, more about big players using the tech behind the scenes.
That's a big part of it, yeah. Institutional DeFi here means established companies, banks, financial firms, big organizations starting to use blockchain, like issuing their own stablecoins on a ledger or tokenizing real-world assets.
Tokenizing real-world assets, like property deeds or bonds or something.
Exactly like that. And the key thing is, these institutions are bringing their existing customers along, often without the customer even needing to know they're interacting with a blockchain. The institution uses the XRPL's speed and efficiency in the background.
So mass adoption, but maybe indirectly, through trusted institutions. That seems to be a major pathway they're seeing emerge now, yeah? A way to leverage the tech's benefits within the existing financial structures.
Fascinating shift. Okay, let's talk smart contracts. This is huge in crypto. But the XRPL, historically, wasn't really focused on layer 1 smart contracts, was it? Why not? And is that changing?
You're right. There is definitely a conscious approach, maybe even reluctance, about integrating complex, general-purpose smart contracts directly onto the main layer of the XRPL for a long time.
What were the worries?
Several things, really. One big one was competing. Could a ledger not designed specifically for smart contracts from day one truly compete with platforms like Ethereum, the whole EVM ecosystem, which is built for that?
Right, the network effect there is massive.
Huge. Plus, there were concerns about building a whole new developer community from scratch for XRPL smart contracts, and potential impacts on the ledger's performance, like would fees become unpredictable? Would it slow down the transactions per second? Would it bloat the ledger data?
Those sound like valid concerns, especially wanting to protect the speed and low fees. So what changed their minds? Why look at it now?
I think the perspective shifted. The realization, as they put it, wasn't about trying to be the best or beat Ethereum at its own game. It was more about expanding the possibilities on the XRPL.
Expanding beyond the existing transaction types.
Exactly. The ledger already has powerful built-in features for payments, the DX, issued assets. They figure that covers, say, 80% of the useful stuff. The idea now is to add capabilities to capture maybe another 15% of use cases by adding just a little bit of smart contract programmability.
So targeted additions, not a total overhaul.
That seems to be the strategy. They're looking at practical ways to do it. One is an EVM sidechain.
Okay, so like a connected but separate chain where Ethereum developers can feel at home.
Yeah, leverage that existing ecosystem. But they're also exploring native solutions, ways to add some programmability directly to the XRPL itself. It's about carefully adding value without compromising those core strengths like speed and cost.
Makes a lot of sense. Very pragmatic. All right, let's dig into some specific developments they highlighted. The automated market maker, the AMM. Why is that important for the XRPL?
The AMM is a really big piece of the puzzle, especially for liquidity. Think about all the different assets that can be issued on the XRPL. Not all of them will have super active trading pairs on the built-in DX order book.
Right, the less popular ones, the long tail, as they called it.
Exactly. An AMM provides liquidity for those automatically. Doesn't need a buyer and seller to place matching orders at the same time. It uses mathematical formulas, liquidity pools.
So it makes trading easier, even for obscure tokens.
Yes. And it also gives people who provide liquidity to those pools a way to earn yield, basically profiting from the trading activity and volatility. They mentioned it can even help reduce volatility sometimes. Plus, AMMs are just fundamental building blocks for DeFi.
And there was something unique about the XRPL's AMM, a special mechanism.
Yeah, they have this continuous auction mechanism built in. It's designed specifically to try and reduce impermanent loss.
Ah, the risk liquidity providers face when prices change.
Right, so the goal is to make providing liquidity more attractive and potentially more profitable. It's a neat piece of engineering.
Okay, cool. Next big one, RLUSD, Ripple USD. A stablecoin from Ripple itself. That sounds major.
It absolutely is. And the key words here are robust and compliant. Garlinghouse really stressed the need for transparency and proper regulatory oversight.
Which makes sense given Ripple's focus on working with the financial system.
Totally. They feel their experience navigating those regulatory waters puts them in a good spot to launch a stablecoin that institutions can trust and use. The expectation is that having a reliable, regulated, native dollar stablecoin will dramatically boost activity and liquidity on the XRPL.
Like oil for the engine.
Kinda, yeah.
Yeah.
We've seen it on other chains. Good stablecoins attract a lot of value and enable more complex DeFi applications.
Yeah.
One important point, though. Because of regulations, you, as an end user, probably won't get RLUSD directly from Ripple. You'll likely access it through exchanges and other platforms that handle the necessary compliance.
Right, the intermediaries. Makes sense. Okay, another hot topic. Real-world asset tokenization, RWAs. Sounds like this is moving faster than expected.
Definitely. Both Schwartz and Garlinghouse seem genuinely surprised by how quickly major institutions are embracing RWA tokenization.
Like who?
Well, they mentioned Larry Fink, the CEO of BlackRock, talking positively about it. That's huge. And there are concrete examples like OpenEden, tokenizing U.S. treasuries on-chain. Ripple itself is even planning to allocate some of its own treasury to these tokenized assets.
So bringing traditional assets like bonds onto the blockchain, what's the big picture significance there?
It's really about bridging worlds. You have regulated institutions issuing tokens representing real assets.
Yeah.
These tokens then live on a decentralized ledger like the XRPL. This potentially allows these traditionally illiquid or siloed assets to be used within DeFi, traded more easily, maybe used as collateral, but still within a framework the institutions are comfortable with. It enables, as they put it, pseudonymous use cases for regulated assets. It's a fascinating convergence.
But if you're tokenizing billions in assets, you need to keep them safe. Custody must be critical. I saw a note about an acquisition medallion.
Yes, exactly. Secure custody is non-negotiable for institutions dealing with RWAs. Acquiring Medallion was a strategic move by Ripple to offer robust, flexible custody solutions specifically for these tokenized assets.
So institutions don't have to build it all themselves.
Right. They can use Ripple's solution, potentially saving cost and complexity. And it seems to be working. They mentioned HSBC is already a customer for this custody service.
HSBC, wow. Okay. Shifting gears a bit geographically, the Japan-Korea XRPL fund, what's that about?
That's about fostering growth in those specific regions. Japan and Korea have always been really active, strong communities for the XRP ledger.
So investing in local talent.
Pretty much. The fund provides grants, helps form partnerships, offers technical support to developers and projects right there in Japan and Korea. It's about boosting innovation locally, whether they build natively on the XRPL or maybe on the upcoming EVM sidechain.
Got it. And what about yield? People always want yield in crypto.
Ah, yes. They definitely acknowledge that. The community is very interested in ways to earn yield on assets within the XRPL ecosystem.
And Ripple's stance.
They support it. They see the development of yield-bearing solutions as a natural and positive evolution for the ledger, making it a more vibrant ecosystem. Specifics are still evolving, but the support is there.
Good to know. Lastly, for the builders out there, anything specific for developers?
Yes, Apex. That's Ripple's big developer conference focused purely on the XRPL.
When and where?
Looks like Singapore, June 2025. Might have been announced a touch early, but that's the plan. Events like Apex are super important for connecting with the community, sharing knowledge, and getting people involved in shaping the ledger's future.
Okay, incredible amount of information there. Let's try to boil it down. If someone remembers just a few things from our chat, what should they be?
I'd say, remember the origins it was built for efficiency and scale beyond Bitcoin. Remember the unique, fast consensus mechanism. Know that the vision is evolving, embracing smart contracts now, but strategically, and definitely grasp the current focus. Institutional DeFi, stablecoins like RLUSD, and RWA tokenization, those seem to be the big drivers now.
And what was the most surprising thing, that aha moment for you, looking back at the history?
For me, it's just that incredible foresight, building a DX, thinking about issued assets like stablecoins way back in 2012. Before most people were even talking about those things.
Yeah.
Yeah, it's a pretty remarkable vision.
So why should you, listening right now, care about the XRPL? How does understanding this fit into the bigger picture?
Look, the worlds of traditional finance and crypto blockchain are undeniably merging. Understanding a platform like the XRPL, especially with its focus on institutional adoption and RWAs, gives you real context for how that merger might happen. It's a key potential player in bridging those two worlds. Knowing its tech, its strategy, its goals, it helps you make sense of the major shifts happening in finance overall.
Well said. Okay, final thought to leave everyone mulling over. Given the strong pivot towards institutional DeFi and tokenizing real-world stuff on the XRPL, what's the next unexpected twist? What new use case might pop up that we aren't even thinking about yet? How else could this tech bridge the gap between old finance and the decentralized future? Something to ponder.